All right, welcome to my video on the DOM. What I'm going to talk about today is the depth of market and how we use it for order flow trading. And so in this section, or in this video, I'm going to cover this in 4 sections here. The first one is going to be market concepts and order flow trading, just to make sure that we've got a strong understanding of sort of market mechanics and why we use this tool. The second thing is going to be the DOM and just taking a look at what it is, what it looks like, and what the components in it are. And then finally, I'm going to talk about designing your own DOM and then just some strategies for using the DOM in trading. And so what I want to go through is keeping this. I want to go through all these concepts, and I want them to be useful to both beginners and more advanced order flow traders. But I want to keep this short and simple too, so that you've got sort of the basis of understanding that you can take it to the market and make use of it. So it's going to be less about me telling you what to do and how to use it, and more about equipping you with the knowledge so that you can make sense of what you're seeing and then design your own strategy around it. Because at the end of the day, that's really what trading is. It's something where you've got all these tools, but having that firm market understanding is going to be really the piece that helps you design those tools best for your own use. All right, so let's go through some of these market concepts. I'm going to do this first by looking at my website, Orderflow US. The reason for this is that I came up with, because of the name, and I think it may be a name that's maybe foreign to a lot of people who stumble upon the market, upon the website. I really wanted to put a definition around order flow, but I wanted to be a simple one. At its most simplistic level, prices are just a determination of what buyers and sellers are doing. So when these people who are in the market, these participants come in and place a buy or sell order, they flow through the market in rapid succession. And so really what's going on is that there's a marketplace, you have a price that's being advertised, and then you've got buyers and sellers that are coming in and placing those orders. And we're going to go through how price moves because of those orders. But when they flow through the market, they're being, in effect, filled by other market participants. And so if I buy a contract or buy a share of something, someone is in the market on the other side of that trade selling that to me. And vice versa. When I'm selling something, someone is buying it from me. So these orders are put through the market, and there's an electronic listing or a record of them. And that's really what we have when we look at the depth of market in the order book. Now, the other thing that I want to do is give you the different names that you may see around the internet for this. So I'm going to mainly call it the DOM, which is the depth of market. But other names that you may see in the market are going to be the order book. You may see it called the price ladder. You may hear it called market depth, and you also may hear level 2 data. And the reason for that is simple, and it's just that it provides an extra layer of depth of looking into the market and what's happening. Because at the end of the day, we could have something where volume, let's say it's just 1 million, and that's a really base layer of information. But when we dig deeper into that 1 million, let's say that it's 400,000 are sellers and 600,000 are buyers, then that starts to give us that second layer of depth. And what we really want to do is use that information to make trading decisions. So, all right, so going into this, I encourage you to, if you haven't already, start to understand why the market functions as an auction and start to think of it as an auction. Not because I said so, but because that's really how a market functions. It's just a price that's being advertised in a marketplace, and then we've got buyers and sellers that are coming in and driving that price up or down. So I'm going to put a description or add a link in the show or in the description of this video so that you can access information around that I've created in the past. And I'll also put a link in this video if I'm able to. I haven't done that before, but I think I can figure it out. All right, so let's go in and think about how we've got this data of buyers and sellers. And let's also consider the fact that we want this data organized so we can make sense of it. I'm going to do this in Excel because I am a big Excel user. And let's go ahead and put 4,200 as our current price level. The market's been trading around here. I'm going to highlight that. All right, so let's say that you open up your app or Yahoo Finance or whatever the case, and you want to know what's the price of Apple. What you're going to get is that current advertised price. All right, but we're not going to get to that just yet. But this is going to be sort of what you see when you first get there. For our purpose, what we really want to do with order flow trading is know what buyers and sellers are doing in that moment. Specifically, we want to know where are the buyers and sellers, and we want to know what they're doing at any given time. And so what we can do, and the way that any DOM is set up right out of the box, is going to be with these three columns. In the middle, you've got the current price. On the left-hand side, you've got the buys, and on the right-hand side, you've got the sells. All right, so when you open a DOM, you're going to get two things. You're going to have the buyers that are lined up on the left and the sellers that are lined up on the right. So I'm going to just populate this with some numbers that are, I'm just plucking out of thin air. All right, and so what we're looking at now is we've got price here in the middle, and we've got our buyers and our sellers lined up. So what I'm going to do is give these prices some names. It didn't quite work. All right, and there's that price. I can put that there. All right, so we've got our prices lined up here, and we're currently trading at this price. What these are called on the left and on the right are the resting orders. And so what you've got here is because 4,200 is being advertised, we can see that on the right-hand side, we've got sellers who are lined up here, and they're at 4,200, there are 150 contracts that are up for offer, that are being sold. And I want to put that name up here too. Offer, also known as the ask. So they are selling at 4,200. They are offering 150 contracts at 4,200. They are asking for 4,200 from their 150 contracts. So I just wanted to provide those names, and they line up obviously very nicely with supply and demand, right? The demand is over here, and they are supplying these things over here. So I'll just put that at the top for I feel like I'm forgetting one of these. In any case, you've got the bids over here, and the buyer, which are the buyers over here, which are demand, and then you've got the ask side, offer, sell. And what we've got now is at 4,200, we've got these 150 contracts that are on offer. If we go just to the price level below, we've got 150 contracts that are being bid on. So those are people who are saying, I will buy at $41.99.75. And these are people who are saying, I will sell at 4,200. Now, if these people say, I will not take below 4,200 for this, and these people here say, well, I will not pay 4,200 for this, I'll only pay $41.99.75, then we've got a stalemate. Nothing will happen there. And you've got that separation there. So what happens is, if no one wants to sell at a lower price and no one wants to buy at a higher price, then we've got that stalemate. However, if someone comes to the market and says, I'll buy it, I'll buy it whatever price you guys are advertising right now. Then what's going to happen is they're going to hit, a market bid. They're going to hit to make a bid, and they are going to do it at the lowest offer price. And that means what happened, and this is where it gets very confusing. I'm going to try to kind of demystify this as we go along. But what happens is when that market offer is made, when that market bid is made, it will hit over here in this column. And so what you've got is hitting the ask, hitting the offer. All right. So let's not get too far into the technology yet, but I just wanted to kind of come up with this sort of skeleton of the DOM. Now, what we've got now is just sort of an out of the box thing, but to even be able to get this, you've got to receive this data and you've got to do it through your data provider. So for me, I've got, I purchased the data pack from SierraChart. And so I've got this market depth pretty, easily from them. I have to pay, I think, $12 or whatever it is per month. For TD Ameritrade users, you can also get it there. The DOM is called the Active Trader. It's free. It comes with the ThinkorSwim platform software. But what you have to do is you have to enable it on the TD Ameritrade site. And so to be able to do that, you can go into your account. You need to hover over Client Services, click General, click on the tab called Subscriptions, enable real-time NASDAQ level 2 quotes. And although the ES does not actually trade on the NASDAQ, what you've got is when you enable that, you can get that market depth. The way I've got this set up on the screen that you're looking at right now, I've got 3 levels of market depth here on either side. In ThinkorSwim, you're going to get 10 levels, and in SierraChart, I can, I've got access to the full depth, and so for me, I can extend it out very, very, very far. All right, other softwares just quickly that have the DOM that I'm familiar with, and I know a lot of people use. I use SierraChart, but there's also MotiveWave, Trading Technologies. I know Jigsaw is a popular one, and so all of these are going to have that DOM. All right, so let's move on to kind of starting to make sense of this. When I first started using it, it looked like everything's moving, right? Everything's moving at a single time. We've got this will be changing. Sometimes price comes down, 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 sometimes up, up, up. So the price will be changing. As the price change, you've got people over here who are changing their limit orders. So these are the limit resting orders. Those will be changing. And then you've got people who are hitting the market and starting to, eat into those orders. And so you've got a lot of things that are going on at once. And so I want to go quickly over what happens when we're looking at the DOM. And let's do it just with this example that I've got built up right here. I'm going to put a few more things, a few more levels. All right, let's go through a quick simulation here. So let's say that we've got this standoff. We've got these 150 on offer, and we have these 150 here on the buy side. How do we get price to move? Well, there's a few things that can happen. Some of these folks who are willing to only buy here may go to market and say, you know what, I don't want to wait any longer, and I'm going to buy, at whatever's available. So let's say that the first thing we have happen, or that we have a buy order. And by the way, 50 just represents volume, but let's call it 50 buys, 50 buy orders. So what happens to the ask? Well, so there's a few things. One, and this is where it gets a little confusing, but because it's a buyer, what it's going to do is record in the system as an ask trade. So a buy records as an ask. The reason for that is that buy is hitting the ask side. And so if we get 50, and we know that we have this 150 lined up here, let's see here. What's going to happen here is that 50 becomes, because 50 hit, that 50 becomes 100. And now we've got a new balance sitting here. But what does not happen is that 4,200 is still the price. And the reason for that is that all 100 of these cells were not taken out yet, right? And so to really be able to move price, somebody actually has to come to market and continue to hit that. So now let's say that 100 more buys come in. This 100 up here goes to 0. Why? Because we had 150. 50 were taken out. We had a balance of 100 here. 100 came in, and now we've got a balance of 0. And what we have now is we've taken out or swept the entire 4,200 price. Now, let's say that this is an advance. Let's say that price is going up. How can we get from 4,200 to 4,200.25? Well, not only do all of these that were sitting here on offer need to be taken out, but we need to start to get through these as well to be able to advance price. And so let's say that we've got a third step in our trade simulation here where we've got 170 now sitting on offer. We've got price having, the advertised price has moved up a tick. Let's say that 190 come in. Now, by the way, in real time, you'll have, sells and buys happening at the same time, right? So it's kind of, I think, conceptually really difficult to get used to that concept. But let's stick with just this example. So 190 buys come in. What happens here is there's only 170. So this 170 becomes 0. We've got 0 recorded. Now, we had 190, right? Not 170. So that 170 goes to 0. And then because it's a market order and because those folks are essentially going to market and say, I will buy at whatever price is available, whatever's being offered, we took out, so because I stopped to explain, let's just go through this again. 190 come in. 170 are taken out. This price level is swept. And this 120, the balance of those 190 buys come in here. And so what we did was we took out 170, swept, all right, and that's how price moves, right? We have this level was swept, this level was swept. And now what we've done is we've started eating out of those remaining 120 contracts, and now we've gotten 100. And so this is conceptually how the market moves prices. This is what you're going to be seeing on the DOM, and when we look at it in a second. All right, so quickly I wanted to go through what happens, or what it looks like, rather, when we... All right, so here's my SierraChart. And this is just the ES and simple bar chart. What I can do is I can go File, Open Trading DOM for this chart, and this is what we get. So let's compare that to what we were looking at. I've got the sell side here, which is here. I've got the buy side there, which is the same as here. And again, as I mentioned, we have the resting orders lined up on either side. So here's the resting orders, and you can see the level of depth that mine has. And so let's go back to just a quick example. Price is currently trading at 46.1775. For that to advance, all of these have to be taken out. For price to come down, all of those have to be taken out. All right, so you've got this two-sided auction, and it's happening in real time. And as you can see, we've got a lot of numbers, and that's really the concept that we're trying to get at here. All right, so let's start to move on now about talking about strategies for getting started in using this. And what I'm going to do now, this is your out-of-the-box DOM, right? But I want to talk about, give an example of the DOM that I use and the way I've set mine up. I'm not sure why this, oh, remove, yes. All right, so what I've got here, a very similar setup. I have, I put in volume over here. It's not, honestly, it's not super useful for me, but there it is. And I've got these resting offers here, resting offers there, and my advertised price there. All right, so what we've got here, the additional, initial component that I've put into mine is these are the market orders that are coming in and hitting right now. All right, and this is where I said things can get a little bit confusing. All right, so let's just take a quick example. And we have 45, 46 that have traded. And this is what it does is it accumulates all the different contracts that have traded at that price. And I'm going to make this a little easier and pull out a second screen that I always like to have up. And that is the time and sales here. I'm going to organize this so that it makes a little more sense to you. All right. You can see, let me just quickly point this out, but I'm going to wait until, all right, so there, 11:52. I'm trying to find a better example. 1 second. Usually what happens is you can see the number that have traded here show up right up here. The reason it's not working right now is because the market's moving pretty slowly, and it's, so there's the 1 you can see. Anyways, what happens is when the market's moving really slowly, you can see like this 14 lot that traded here. There it is. Sorry, there it is. It's moving on me. And what this means, and let's try to make sense of this now, because I think this is the most difficult to grasp concept, especially when you're getting going, right? But what we've got is, I'm going to come here and look at an ask trade. Volume 11, ask trade at 42.16.25. How do we make sense of this one right here? All right, well, an ask trade, these things actually kind of come at an inverse. So an ask trade, on the one hand, you may say I think of a bid as buying and an ask as selling. You need to change your thinking to be inverse of that for when we're using the DOM, and that's just a simple function of where the trade is recorded. So if we've got 11 volume at 42.16.25, that means that 11 contracts were purchased on the ask side. And so it kind of comes back. So let's use that 11 as an example. Let's come back over here. Lost my window. All right. If we have an ask trade 11, we're going to have 11 hit the ask. So let's say we had 100 there. We have 100, then we had 11 hit the ask, and that 100 becomes 89. And the reason for that is that those 11 contracts hit that 100 on the ask and took out 11 of them, leaving a balance of 89. All right, so that's sort of how you start to think about it. And it's, for me, it was the hardest concept at first, and it took me a while to really conceptualize, and then not only conceptualize that, but then be able to like look at it in real time and think about it that way. So perhaps a good place to start, and exercise 1 would be to just spend some time watching these things in real time and being able to, get that muscle memory going to where you really recognize that inverse, and an ask being something that is a buy but hitting on the ask side, on the right side. All right. By the way, I should also mention, and I can make a link to this in the YouTube video and also just in the description, but it's US regulation that these are lined up and staggered in this way. So all the sales have to happen above where the current advertised price is, and all the buy orders have to be lined up below the current price. So you'll always see it that way based on regulation. All right, cool. All right, so now I want to make quick reference to the article that or blog post that I recently put up. I'll also link it in the notes, or put a link up here in the YouTube video. But when we're looking at the market, some of the general principles that we're always trying to bring into the equation are liquidity, volatility, volume, and then certain trading strategies around absorption and consolidation. So those are things that we can measure in the market with speed, volume, and activity. And that's really the offering of the DOM, of the price ladder. With regards to speed or the pace that the market's moving, you may be able to use like the slope of a candlestick. So if I pull back up the Sierra chart that I just showed, this is on a daily chart, and you can see this is sort of the slope that we're at. And this is the speed that we're moving up, right? But if you're doing that in the intraday, we're going to want something that's going to give us more of a quick indication. And that's one of the things that you can really use the DOM for, is indicating that early movement before others can, using a candlestick. And then additionally, volume is just a concept that I've covered very well. So the way that you put your strategy, is going to be very dependent on, how well you grasp these concepts. So covered in that blog post, and may require additional study on your part. So, and then finally, the other thing that we want to consider is activity in the market. And this is something that can be thought of as the nature of the buying and selling that's happening in the market. And I think that that's really where the DOM delivers best, is small shifts in that activity. So what I want to do now is just provide an example. We've had this DOM playing right now, but I want to provide an example of how we can use it in making a trade. And what I'm going to use is a trade that I actually made the other day. I got lucky enough to be sitting at my computer when it happened. I'm going to set this to replay on June 3rd, 2021 at 8:44 in the morning Mountain Time. 8:44 Mountain Time is 10:44 a.m. East Coast time. All right, so what I'm going to do as this loads is tee this up. What happened that morning was I'd been watching the DOM. As far as I recall, there wasn't a lot of activity. Nothing really kind of caught my attention yet. And when I'm watching the DOM, the one thing I always want in the intraday or any other time is just this relative feel for how the market is trading, how the market is moving, and how quickly things are happening. So here we are. Here we are trading on the morning. You know what I'm going to do? All right. 8:44 in the morning. You can see that right here. Right off the bat, you can see we've got the DOM set up. We've got the price level here. This is what's being advertised. And what I want to draw your attention to is when you're looking at this, let's initially look at like what's happening, right? We've got these 80, 70, 20, 30, 30, 20, 20, 10, 28. Not a ton of activity. I know that because I watch this every day, right? And so off the bat, I'm watching it thinking not a lot's going on here. But remember what I said, we want to use these terms of how, we want to use these concepts to, read market activity by looking at things to measure, like speed, volume, and then taking in like a general sense of the activity. And so these are things I can't really necessarily give you a definition around, especially activity. It's something that when you show up and do this every day and put the screen time in, you can detect those relative shifts. But off the bat, we're looking at relatively no activity. We're in this little range. We're not seeing a lot of volume. Now, at the time, I did not have the news open. I didn't have any websites open. I had no idea actually what was going on. And so what I was doing was just looking at small shifts in the market and looking for some sort of sign. This is not a level that I was watching. This is not support or anything. I was just watching the market. All right, so we're at 8:45. A minute has passed. Again, if I pause it, volume is pretty much nothing. Again, this is something that when you show up every day, you kind of get a sense for what movement looks like. Now, unbeknownst to me, what happened was around this time, news came out that Biden and the Republicans had come to an agreement to lower the corporate tax rate to 15%. I believe they had come to some sort of agreement. I think Biden wanted higher, and he acquiesced a bit. We had 94 come through. That's, I don't know, relatively higher than we've seen, but not really. Still nothing important going on. $50 contracts, 20, and now we've got our first sign of change. Again, I was trading this, so I remember this just the other day. 41.75, and for the first time, we've got a big 300 come through. Now let's talk about how to quickly interpret that. It's a bid trade, 317. What that means is that 317 orders hit the bid, specifically here at 41.75. Sorry, that got a little messy. 41.75 is right here. All right. When 317, if we come back to our example, right? Let's keep that 317. So if 317 hit a certain number, that means that they have to, at this price level, they have to reload the bid side to be able to take in those orders. Now, if 317 hit the bid and, this gets taken out, this gets taken out, this gets taken out, what happens is price will begin to move lower. Given what we've already looked at so far, we haven't seen anything bigger than 100. So to have 317 and price not move down, we've got our first clue that we may have absorption. That's high volume. That's compared to what we've seen so far, that's astronomical, right? And this kind of gets at that concept that I put out in that general principles post. But when that volume is that high, we can start to think that this is getting absorbed. So let's keep watching. 317 came through. Now we've got 94 also hitting. Okay, now let's pause again. Now, so we had 317. We remember that it hit 41.75 and price did not go lower. Well, now we've got 800, over 800 here coming through, and still price is not going lower. What does that tell us? All right, 800, first of all, we know that that's higher than anything we've seen so far. The other thing that tells us is that even though we're only seeing 100 contracts sitting here on the bid, that means, somebody is in the market refilling those really fast. The other thing that means is that as they hit the bid and continue to not move price, that we may have, what's happening right now is we may have massive selling coming into the market in terms of volume, but there's a buyer on the other side of that saying, I will buy this. They're supplying those contracts that people are selling. All right, 863, 900, 1400, 1500, 1800, and we end up with now 1800 at that 41.75 price level. And what happened to price? It did not move at all. We can see that by that red line. And again, that means that those sell contracts that are hitting the bid, somebody is sitting here at 41.75, probably a computer program, and that is just reloading because they've got an order to fill. So for me, what I thought when this happened in real time, and I can actually demonstrate this now, is that I said, I want to go to market and buy. I'm going to put a tight stop in here. If that 41.75, if we lose that price level, if that buyer is not there anymore and absorbing those sell orders, well, then we're going to trade through it, and my stop will get taken out. I can live with that. But what I was surmising here was that we have a big buyer in the market. I got long. I'm willing to live with this small risk. Because I saw this order come in real time, I've got a leg up on others in the market. And now the only thing that's left to do is monitor for continuation. And what I'll do is speed this up 3 times so that you can see how this trade played out. I'm continuing to watch over here just to see, I want to see that the flows are coming in. If we had such a strong buyer, I want to see more buyers come in to take price up, right? We've got 100, it's moving kind of fast now, but we've got all of these orders lined up to stop price from moving any higher. So can we take those out, and with what level of efficiency? This is something that you have to ask for, you have to answer for yourself when you're looking at markets. But I'm going to make this up. I don't remember at the moment where I got out of this trade. Let's say I want to come up here and make 20 points. I just want to see that the auction activity is going to sustain my long. I just saw 100 come through, 139 buys, 174 just hit the ask, came through. If I saw something like 900 sitting here on the offer, I might get worried, but I just saw over 100 come through, and there goes, it just took out my limit. That's a 20-point trade. All right. Yeah, I'm sort of cherry picking because I watched this trade the other day, but at the same time, what I'm trying to illustrate here is that we have all of the components that would give you conviction to enter this market and put a tight stop and live with that risk. When you've got absorption to that degree, well, there's no magic number where I can say, 1,820 contracts. We consider that absorption. However, just having watched the market day after day, having watched it all morning, I can tell you that that's a big number, and that's something that we just kind of looked at in the time and sales window too. So what I tried to do in this video then was just give you, the beginners, a basic understanding of how things are showing up and what they can do and what they can watch for to start to put this into action. And then if, for those who are interested in sort of these general principles that I previously gave, well, that's what absorption is. And so I recommend getting your bearing first. And so if there were some exercises that I were to recommend, you may want to just watch for activity, specifically watching for change in speed, volume, etc. Another thing you may want to do is getting used to being able to understand the difference between an ask and the ask and the bid trades that come through the market. Again, I think the colors and I think the out of the box and just the terminology makes it difficult. And then a third thing you may want to do is start to note relative change day to day. Again, I kind of refer to how I was describing this when we did the video just now, or the replay. But because I've done this day in, day out, I can tell you, I rarely see 300 turn into, another 1800. So that's something that for me, it's just a pattern that I can recognize from having done this day after day. And the more that you come to the market every day and watch these things, the more you're going to be adept at recognizing those changes and making the trades in real time. And so I think that I'm going to conclude there, but I think the most important part is just to start to get that familiarity and build around it. And then what I'll do is start to continue to provide more information, videos, and so forth. And so with that, I am going to leave it. And thanks for watching this. And as usual, any questions you have or background information can be found at my website, Orderflow US, and that's www.orderflow.us. All right, that's it. Thank you.